And let's move on to the markets. Of course, Nigeria's market did pretty well last week, up almost 2%. Today, we begin to see some pressure from profit taking. The NSE All Share Index closing at 33,811 points, down just under 0.25%. The main pressure point really was from Nigerian breweries. That stock taking a bit of a beating today. Some profit taking pressure there, taking that stock price down to 161.2 naira, while WAPCO also fell back. Cadbury falling back as well on profit taking. Let's now cross to the Nigerian Stock Exchange to speak to Victor Ogiemwonyi. He's the CEO of Partnership Investments. Victor, it's great to have you on our show today. And I want first to get your thoughts on the profit taking we're seeing in today's session. I do know that we did see profit taking on Friday, but the market was lifted by the gains we saw in Dangote Cement. Your thoughts on the consecutive sessions, if you like, of fairly significant profit taking?
Thank you very much, Wole. It is apparent that given the fact that the market has gone up very steeply in the last few weeks, there'll be anticipation of those who want to take profits. And I think this is going to continue a bit for some time. However, they are not significant enough to affect the upward movement of the market. If you look at it's very marginal, it's less than 0.25%.
Yeah.
It means that the broad market is still, is still going up, and then everybody believes that this rally has legs. If you imagine that we're just at 33%, and at the very height of the market in 2008 before the crash, it was 66,000. So we have a fairly broad confidence coming up. We are seeing that the retail investors are beginning to come back to the market, though slowly, but there's every opinion is pointing to the fact that the broader market will continue to inch up gradually.
You mentioned that the retail investors are coming back to the market, but to what extent though? Because we know that in the past, especially when you look back at when the index was over 66,000, the retail investors were really in this market with a lot of leverage. Your thoughts on the extent to which they are participating in this bull run?
Well, so far, retail investors were hurt the most in the last crash. So they are very reluctant. However, we are beginning to see that they are coming back slowly. If you look at the volumes in the last few weeks, today was a bit of a surprise, but the volumes in the last few weeks and the value is showing that confidence is gradually returning to the markets. And then also forget that we are looking towards the end of the month. And, most people are adjusting their portfolios for the end of the month. Also look at the fact that the bond market has tightened a bit. The bond yields are up because of the good news about inflation coming down. So these are things that will impact the market slightly. But the overall look is that the market will continue to go up. Retail investors will continue to come in. And we also believe that there's no leverage, serious leverage in the market yet, and that is going to come in as we go along.
We'll come back to the discussion around leverage because I think that is important. But what about the institutional investors? I was speaking to a pension fund manager earlier today. He is saying that allocation to the equity market may have increased from as low as 5% to as high as 15% for some pension fund managers at the moment. But outside the pension fund management industry, of course, we have the likes of the insurance companies. To what extent are other institutional investors getting involved in this bull run?
Well, the first thing is that it's obvious that the institutional investors are gradually coming back. Pension funds allocation is definitely up. Then you also know they also will be the first to also take profits, and therefore is a seesaw of some sort. If you look at all the other institutional investors, they are looking at the same thing as everybody else is looking at the market, that the market broadly is coming back, and therefore there is time to take a position. One of the most significant things that we are going to watch out for this quarter is that when the results are coming out, we've seen results of Nestle that buoyed the market very strongly last week. This week, the Nigerian breweries have announced its results, but even though it looks impressive in terms of its 19% growth and 8.5% in profit, people still feel that the 3 naira dividend paid on a 160 naira stock is very low, and so it took a beating today. So we are going to see that other institutional investors, obviously like insurance companies, are not ready yet because they too have seen their balance sheet flattened out by the losses of the last 2-3 years. So I don't see them coming as strongly as all the other areas, all the other investors for now. Maybe as we go along, they will join the trail.
All right, let's talk about leverage. Of course, we know this market, if you like, thrived maybe for the wrong reasons on leverage in the past. But of course, we know that there's a need to provide that infrastructure for investors who want to, should I say, increase their risk and of course improve their returns, to have that opportunity. Give us your thoughts on what is going on around that, providing the infrastructure for leverage to continue to begin again in this market.
Yes, we all know that the stock market cannot essentially go as much as it can without some kind of leverage. Leverage will come. However, right now the banks and all the people, who provided leverage in last time with margin were not quite adept at what was supposed to be done, and most of them felt that they lost out. Now, the Securities and Exchange Commission, working with the central bank, are trying to put some framework in place. First, they are going to bring out what they call marginable stocks, and then they're also building capacity for the SEC and other people who are around the regulatory bodies to be able to get capacity to understand what is going on, so that if leverage is going too far, they will be able to see it. Until those ones are put in place, I don't see leverage coming fully. Right now, the leverage in the market is very thin. And, you can understand that banks are the major providers of such leverage. And right now, they are not in the mood, especially as they're just cleaning out their balance sheets. So we're going to see some of it, but they want to wait to see how real the rally is and how real the market comeback is. Well, I think when we see a strong market comeback, we'll see the leverage reappear on its own.